What other career allows you to fail 90% of the time, but you still get paid a lot? You know, that's incredible. A lot of people don't realize that they're paying fees at all. And even the stars of today could be the duds of tomorrow. So I think that's the difficulty. So what seems like an innocuous 1% actually ends up scooping out like 10, 20% of your long-term gains. 90% of my personal wealth is in one fund, one global equity fund. That's it.
Welcome everyone, this is Mariusz Konieczny. Today I'm chatting with Roman, who has a unique background on the institutional side of investing and now on the retail side. So Roman, thank you very much for joining me.
My pleasure, Mariusz.
Okay, so you used to be in investment banking. You appeared on CNBC, Bloomberg TV. So you were on the institutional side of investing, and then now you have a YouTube channel, Pension Craft. You have some courses. You teach people. You teach retail people how to invest. So tell us your story.
Yeah, so I worked in investment banking for many years. I did a lot of training before I did strategy. So I was a strategist for many years, but before that I did training, and I really enjoyed the training. But obviously, if you're in the front office...
Oh, you mean training, not trading. Training.
Training. So
okay.
When I moved, I had a quant role initially, and then I moved to kind of training. So we were teaching the staff of the clients, and we taught them about every different asset that we traded. So that was credit, equity, derivatives, everything. And if you stand in front of clients and you're teaching about every asset that an investment bank trades, you better know your stuff, because they'll pick you up on it, right? If you don't know your stuff, you'll be damn sure that you will know it by the end of a couple of months. So that was great. It was a baptism of fire, but it forced me to learn about everything that we did, from structured products all the way down to the individual, the way that the trades were settled, you know, everything. So that was such a good grounding in how finance works, because you get to speak to clients from every single walk of the world, and you understand the products. And then as a strategist, it was also great because I got to speak to the clients themselves, you know, because you write the research and then you go and market the research. You fly out to speak to the pension funds, the hedge funds, the sovereign wealth funds, really smart people. And often you learn as much from the client as they learn from you. I saw myself as a kind of financial bee. You know, I'd move from one flower to the next. I'd give them my ideas, but there was a lot of cross-pollination of ideas. But it was a brilliant way to learn, you know, really to learn how finance works, who the players are, what the incentives are, also very important. And yeah, I loved every minute of it. And then I left that in 2016. I started Pension Craft in 2017, and I've been doing it ever since. So a big change for me career-wise.
Why did you want to do that? Leave, I mean, a high-paying job, you know, to do YouTube?
Well, I lost my job, so I was laid off. So you know, but you know what it's like in investment banking. You've got to be prepared for that, because at certain points in time there were just mass layoffs. So you always wondered when the axe would fall. So you always had a plan for what you were going to do, and it was always like, you know, when you're at the pub, you discuss what you're going to do when you leave. This was my plan. So you know, I just thought teaching is what I love. As a strategist, I didn't get to teach, but you know, I just knew that's what I'd enjoy. So that's what I'm doing now. I'm kind of giving that knowledge, which I gained over many years, to people, just so they understand how finance works. They don't do anything stupid. They understand the incentives of the people that they potentially trade with, their broker, their advisor. And once you understand the incentives, I think it gives you a much better grounding in who to listen to and whose interests are aligned with yours, put it that way.
Okay, so how does the finance work, and how do the incentives work?
Well, I think it's always good to know how people make their money. For example, brokers, they make money on bid offer spread. So if you trade a lot, they make more money. Advisors, it's based on the amount of money which they manage on your behalf. They take a percentage. So the more of your money which they manage, obviously the more money they make. And that's true whether you make money or not. They always take their cut. Same for fund managers. Again, it's a size of the pot model. So once they've gathered enough assets, they're done, right? They don't care beyond that point. So really, you've got to find an investment strategy which, given those interests, is going to work well for you. And one thing I didn't realize when I was working in investment banking was that many active managers don't generate performance above the market, because who would discuss that, right? It was just assumed that the clients I was talking to would be able to beat the market. Sure, some of them would be unlucky, but on average, you'd have thought they're being paid these very, very high fees, that they'd beat the market because that's their job. But what I learnt when I left banking was that that's not true. Most of them underperform a passive benchmark, which makes you think, well, why am I paying these fees? And, why bother with active funds if they're not going to outperform? What other career allows you to fail 90% of the time, but you still get paid a lot? That's incredible. And that people carry on paying for active management despite that. So, a big part of my message has always been know what fees you're paying and the likelihood that it's going to benefit you paying those fees.
So why do people pay managers to underperform?
I think part of it's ignorance. A lot of people don't realise that they're paying fees at all. When you speak to people, you say, what are the fees for these funds you've got? And they just, you just get a blank look. I think that's changing now, but previously, when I first started, I think the awareness in the UK was very low about fees. A lot of my clients that I speak to now, they've already watched my videos, so they know fees are very important, because we recently created a calculator which we call GULP. It's gains ultimately lost to professionals. But what we tried to do is look at the compounding effect of fees. And there's a vast difference if you get the fees from 2% down to 0.2, because every pound that you pay in fees will not be compounding forever. And that compounds to a huge difference. So what seems like an innocuous 1% actually ends up scooping out like 20% or 10-20% of your gains long term. So I think that's why I have such a focus on fees, because I just think that people that aren't aware of it, and they should be. But why people are willing to pay it? I think they assume that it's kind of like a fancy car. If you pay more for it, that it'll be a better product. Whereas in finance, strangely, it's the opposite. Often the less you pay, the larger the economies of scale for the fund. Often it's a passive fund, and the better the outcome you get, which is very odd.
Mm-hmm. Okay. And in the investment world, you have those opinions that professionals, institutions are so smart, they have all these tools, you cannot compete with them. And then there's this other opinion where retail actually does have an edge over institutions. And I was wondering where you stand and what your opinion about this is.
Yeah, look, a lot of the people I used to speak to, who, I'd almost consider friends, they weren't deliberately being obtuse or stealing money or being lazy. These active managers, they're incredibly bright and well-resourced. They've got Bloomberg terminals, they've often got their own research department, and they've got access to all of the research from the investment banks. And yet, they still underperform so often. Why is that possible? Well, it's because it's really hard to beat the market. And I think people don't appreciate this if they're new to investing. You don't realise why. It seems obvious, doesn't it, that if you've got a whole market of stocks, let's say it's the S&P 500, if you just cross off the no-hopers, You know, the really awful stocks, you should outperform, right? That should be easy. But in fact, it's really hard to do. Because yesterday's no hopers may be the stars of the future. It's really difficult to predict which ones are going to outperform, and stock selection is difficult. So I think...
Well, and you know what? A lot of times I see that a stock will perform really well when the situation goes from completely hopeless to somewhat hopeless.
It's the delta, right? That's what matters. And even the stars of today could be the duds of tomorrow. So I think that's the difficulty. Today's data doesn't predict the future, and stuff is changing all the time. And even though you're well resourced, very intelligent, some of the brightest people on the planet, let's face it, and you're very well paid also, it doesn't mean you're going to outperform. So, you know, I don't think we should kind of hate fund managers. I think we should just be realistic about what they can achieve. And how do you find them? That's the other problem. If there's a really good manager, given their history of performance, it's very difficult to find one which outperforms consistently. There's something called the Persistence Scorecard, which is run by S&P Index versus Active, the SPIVA report. And they look at the outperforming funds right now, and then they track that through time. Now, if it's luck which makes them outperform, then what you'd expect is over time it would be like a coin flip. Will it outperform next year, the year after that, the year after that? If it is luck, then the outperformance should decay. And what they actually find is it's almost indistinguishable from the coin flips. So it looks like it's a kind of chimps and typewriters, right? If someone outperforms consistently, it won't last forever. So that's what makes it so difficult, I think, to find an active manager which is going to outperform consistently in future. Warren Buffett is special because he may be one of a kind.
But do you see that? Well, I see it on my end that a lot of professionals, they will not enter into positions, long-term positions, because they're so focused on how these positions will perform from quarter to quarter. Do you see that too?
Yeah, I mean, look, there are certain times when a fund manager may think, look, I want to take risk off the table, but they're not allowed to. So often they have a very strong remit. They have to match some benchmark, they have to have certain risk limits, you know, and they've got to keep their job. You know, all of those are the incentives for the fund manager. And if they're in cash, well, they're going to lose their job if they hold it for any length of time. If they underperform consistently for any length of time, they may lose their job. The fund may get wound down. So I think a lot of the expectations about consistent performance are also difficult, make life difficult for the fund manager to perform well. There isn't such a thing as patient capital. You know, if they underperform 2 or 3 years in a row, they're in real trouble, and they'll get outflows because people are very impatient with their money. So
yeah, that's true. That's true.
I don't think it's easy for the fund managers.
So with PensionCraft, how do you equip retail investors? What is your strategy that you're teaching?
I think make it empirically based, right? Listen to views, always interesting. Read the market news, always interesting. But focus on what works. And what works consistently for almost everyone for any period of time is a passive approach, a simple approach, and a low fee approach. I think that's what's most likely to work for most people. If you do want to dabble in active funds, sure, go ahead. If you want to do stock picking, go ahead. But do it for a small proportion of your portfolio, because you should weight the strategies according to their probability of success. So that's why 90% of my personal wealth is in one fund, one global equity fund. That's it. 10% is my fund portfolio where I do all the crazy stuff. Single stocks, strategies, leverage, cryptocurrency, you know, everything toxic. That all goes into the 10% fund portfolio. But the core, which is the bit that I think matters, is in one fund. So I don't tell people to copy me, but I do focus on simplicity. You know, if you've got more than 5 funds, you've got to question why. Usually it's best to keep it simple. 2, 3 funds is probably enough for your core. And, you know, obviously all the other stuff about investment horizon determines your risk appetite. You've got to consider your risk capacity. What's your economic capacity for loss? What's your ability to live with volatility? Because if people don't like volatility, you don't want too much equity in the portfolio, even though economically it might make sense. Psychologically it doesn't. So really it's about finding a portfolio that's in tune with your goals and your character. So that's our philosophy. You know, keep it simple, keep your fees low. Most of it's about index funds, but a lot of the discussion is about stuff in our fund portfolios.
Okay, but I could communicate this strategy in 30 seconds by an index fund. But you have a YouTube channel, you have people that you need to talk to, entertained, and saying this is boring, right? So how do you keep people entertained when you tell them just buy an index fund and go to sleep for 50 years?
Well, I think it's kind of like The Karate Kid, you know, the movie, where you kind of start off as a kind of white belt, and you have to learn all the different katas, and you have to learn all this stuff, and you assume it's complex, right? Karate. But then when you go past black belt, you go back to white belt. It's a little bit like that.
Back to the
You
basic
assume that-
fundamentals.
Yeah. And I think, yeah, people assume that because you've been in finance, you've been in investment banking, that you have a really complex portfolio with derivatives and really fancy stuff. But in fact, if you speak to most of the people on the trading floor, a lot of them anyway, you'll find that they do go for the index approach because they haven't got the time, right? You get home from the investment bank, you're not going to spend your time stock picking, or maybe for fun, you know, but for the core, that's their strategy, and there's a reason for that.
So if they don't have time, what is their day? What does their day look like? What do they do during the day if they're in investment banking?
It depends on the job, right? I mean, I wrote a book called The Financial Bestiary, and what I have at the kind of introduction is like a picture of each of the different jobs. So trader, sales, structurer, debt capital markets, equity capital markets, the back office people who make it all work. Because, you know, for every front office person, you've got like 10 people in the back office doing stuff, making the plumbing work. You know, this trade has to go into this place, has to be booked on time, it has to be booked correctly. So, I mean, it's almost like saying, you know, what are the jobs in a factory? But the most important jobs in the factory are the ones that talk to clients. So you've got sales and trading. So trading are the kind of semi-autistic people who focus on one asset class, and the salespeople are the people with the shiny teeth and the nice suits that actually talk to the clients. You'd never let a trader talk to the clients. It's always the salespeople. So if you look at the average trading floor, you'll see that breakdown. So it's broken into desks. If you walk through a trading floor, so you'll have an FX desk, you'll have a bond desk, which is broken into subgroups by asset type. And then within each of the groups, you have sales and trading. So sales speak to clients, trading are the ones they shout at to get a price for the client. But increasingly, that job's been moved online. So sales and trading on the trading floor is really just for the large trades, the large institutional clients. And even more and more of this stuff is going to move to the electronic space. And then at the back office, you've got all sorts of stuff going on, right? The operations people are the ones who make the plumbing work and make sure the trades book correctly. You've got your risk and compliance people who make sure you don't all go to prison and get the bank shut down. You know, loads of jobs. And of course, you've got the HR people, which you'd have in any organization.
Okay. All right. Perfect. Thank you. Do you have any final thoughts that you would like to leave my listeners with? And finally, how could they find you and learn from you if they choose to?
Yeah, sure. So we've got a podcast. It's called Many Happy Returns, which many people enjoy because it's quite casual like this. You know, we laugh a lot, my co-host and I, Michael, and it's quite relaxed. Obviously, we've got the YouTube channel, Pensioncraft, and a lot of people use that for kind of content in terms of learning. It's more formal. You know, always feel as if it's more formal when I'm doing the YouTube videos. And we've got our membership, so you just go to pensioncraft.com/membership, and you can join our community. I do lots of members-only content. I think I've almost got 300 members-only videos now, which I've done over the years, explaining everything you could possibly imagine, from tax to derivatives to macroeconomics, the whole thing. So that's where people can find us, and the community is pretty cheap. So we try to keep the fees as low as possible. Part of our philosophy, if you like. So almost anyone can afford it.